All right, let's jump right into this explainer. Today we're unpacking a pretty sobering but absolutely fascinating macroeconomic thesis about an impending market transition, and more importantly, how to strategically navigate it. Whether you're deeply entrenched in the financial markets every single day, or you're just trying to get a read on where the global economy is heading, the source material we're looking at presents a really compelling argument. We're going to explore a very specific perspective on our current financial system, one that suggests massive structural cracks are being hidden by policy, and that a seismic shift in capital is right on the horizon. We'll be looking at what they call the Humpty Dumpty crash and the golden parachute that might just save savvy investors.
Here's our game plan for today. We're going to cover 1. The elephant in the room, 2. The Humpty Dumpty crash, 3. The precious metals solution, 4. Building a mining portfolio, and finally, 5. Spotting froth and exiting. Let's get to it.
Section 1. The elephant in the room. So, to really grasp this source's entire thesis, we first have to look at a massive, glaring disconnect in global monetary policy. The analysis basically points out this huge gap between what central banks say they're doing and what they're actually doing behind closed doors, just to keep the lights on. They argue that policymakers are trapped in a system that's literally so fragile that preventing a total meltdown has quietly superseded all other economic priorities. As the source puts it, the Humpty Dumpty crash is coming. It's becoming the elephant in the room. If the financial leaders actually admitted how fragile everything is, well, the panic alone could trigger the exact crash they're terrified of. So the elephant just sits there, getting bigger.
I mean, look at this. We all know the Federal Reserve's official dual mandate, right? Keep prices stable and maximize employment. But critics are pointing to a completely different reality. The argument here is that making sure the bond and stock markets don't literally burn to the ground is now their only actual objective. Because we have these astronomical debt burdens and sky-high asset valuations, every single interest rate tweak has massive ripple effects across interconnected global markets. So, maintaining this illusion of stability is the real mandate now, even if that means letting inflation run hot or just sacrificing those other official goals altogether.
Moving on to Section 2, the Humpty Dumpty crash.
So if their entire focus is just propping up these fragile markets, what happens when those props finally snap? It's pretty eye-opening to contrast past crashes with what we're looking at today. Think back to the fallout after the euphoric runs of the 1920s or the dot-com bubble in the 90s. Back then, the US was the undisputed global heavyweight. The dollar wasn't really at risk, and the bond market wasn't this inherent house of cards. But the source argues the next projected crash is a totally different beast. Why? Because it's hitting right when US geopolitical dominance is actively being challenged, the dollar is facing serious headwinds, and the bond market is incredibly fragile.
The source really highlights how these underlying pressures make today's environment so uniquely dangerous. We've got countries aggressively shifting their trade away from the usual hubs. At the exact same time, central banks are just hoarding gold at record levels. Throw in persistent fiscal deficits fueled by modern monetary theory, which, by the way, the source argues is essentially a hidden tax that's completely crushing middle-class purchasing power. The argument is basically that the middle class is getting rug-pulled by rampant financialization. So you mix that over-leveraged domestic economy with high geopolitical risk, you get a crash scenario where the system just can't bounce back intact.
Which brings us to Section 3, the precious metals solution.
Okay, so if traditional assets are sitting on a fault line, the obvious next question is, where does all that money go when the music stops? What's the ultimate safe haven? The number you really need to wrap your head around here is $250 trillion. That's the estimated value of global assets currently in the crosshairs, roughly $100 trillion in stocks and $150 trillion in bonds. According to the analysis, if faith in this fragile system starts to crack, that capital is going to scramble for a new home. And here's the kicker. Even if just a tiny fraction of that $250 trillion pool goes looking for a safe haven, it could trigger a massive, unprecedented shift in the markets.
The source emphasizes that in a scenario like this, gold stops being just another commodity and actually reclaims its title as the ultimate financial alternative. I mean, historically, during times of extreme uncertainty, gold has always stepped into this exact role. And like we talked about a minute ago, central banks are already front-running this move by stacking their reserves. Now, the analysis does point out that while silver and the mining companies are going to benefit hugely from this macro shift, they're kind of just along for the ride. The main event, the real underlying current driving all of this globally, is capital rushing into gold as a definitive trusted store of value.
All right, Section 4, building a mining portfolio.
Now that we've mapped out the macro thesis and this massive pivot to precious metals,
let's get into the weeds on tactical execution. How do you actually build a portfolio to catch this wave without taking on crazy amounts of unnecessary risk? Well, the source lays out a very specific risk-reward pyramid. They actually draw a parallel to Michael Burry's playbook right before the 2008 housing crash. It's all about targeting that optimal risk-to-reward ratio. The strategy is to dump the vast majority of your funds, we're talking 70 to 80%, right into what they call the sweet spot. These are your undervalued producers and high-quality developers. Then you allocate about 20% into the base. Think major companies, ETFs, royalty plays. Those give you lower volatility and a sturdy foundation. Because let's be real, nobody knows the exact timing of this market reset. And as for the peak, those highly speculative exploration companies, the advice here is to basically ignore them completely during a bull market.
By zeroing in on strong fundamentals instead of chasing whatever the shiny new short-term trend is, the goal is to multiply your investment, but do it conservatively. The source explicitly talks about aiming for a 5 to 7 bagger return, meaning, 5 to 7 times your initial investment. The whole philosophy here is that you don't actually need to climb to the very top of the mountain to win big. You can lock in life-changing gains right there in the sweet spot and just leave those wildly risky, euphoric, top-tier gains on the table for someone else to gamble on.
And finally, Section 5, Spotting Froth and Exiting. Getting into a trade is really only half the battle, right? Knowing exactly when and how to get out is what actually separates successful investors from everybody else. But before we even touch on the exit strategy, the source throws out a pretty brutal warning: 90%. That is the estimated chunk of people who end up losing money trading options. In fact, the source is so adamant about this that they completely stripped the chapter on options trading out of the latest edition of their book. The logic makes sense. In a major precious metals bull market, you've already got plenty of inherent leverage. You can bag massive returns holding standard stocks without trying to do a high-wire act with options. Factoring in human emotion and the need for literally perfect timing just makes options way too dangerous for most of us.
Okay, so how do you actually know when it's time to cash out of those standard stocks? Well, instead of relying on your usual price-to-earnings or PE ratios to spot a market peak, the source has a very strict definition for market froth. They watch free cash flow multiples. Right now, according to the analysis, the highest quality gold and silver producers are just sitting there with free cash flow multiples in the single digits. Why? Because the broader market hasn't quite bought into this thesis yet. But once that sentiment flips, those multiples are going to absolutely explode.
To handle that, the source outlines a really strict 3-step discipline for getting the heck out. Step 1. Monitor those free cash flow multiples closely. Step 2. Wait for your top-tier, highest-quality producers to see their multiples break out of the single digits and climb up into the 20s. As soon as a few of them hit that 20 mark, that's your signal to start heading for the doors. When they all hit the 20s, you are completely out. Following this ensures you preserve your capital by leaving exactly when market enthusiasm gets totally unsustainable. You're not trying to perfectly time the absolute top. You are just securing your profits before the mania inevitably collapses.
So whether you're completely sold on this pretty severe macroeconomic outlook, or you just want to understand the mechanics so you can hedge your bets, you gotta admit, it's a thought-provoking analysis. This transition away from a debt-heavy, policy-prop market could very well be the defining financial event of the coming decade. Grasping these hidden market dynamics, staying far away from the high-risk options trap, and locking in a disciplined, numbers-based exit strategy, that is step 1 for protecting your portfolio. So I'll leave you with this. When the structural cracks finally reach the surface, are you going to be caught in the Humpty Dumpty crash, or will you be safely holding the golden parachute? Keep learning, stay focused, and thanks for joining us on this explainer.